Welcome back to Iron Financial. We're the place you come to forge a stronger portfolio because we stress test the market's biggest names. I'm your lead analyst.
And I'm your market skeptic. Today we've got a titan under the microscope, J.P. Morgan Chase. Their latest earnings just hit the wire, and let me tell you, the numbers are telling two very, very different stories.
Yeah, so we're here to cut right through that noise and figure out what it actually means for your money. Let's get to work.
You know, for years, JP Morgan has been the textbook definition of a financial fortress. Just a behemoth with a balance sheet that you'd think, would stand pretty much any storm the market throws at it. But here's the thing. Every structure, it doesn't matter how strong it looks, has pressure points. So what we're doing today, it isn't just about reading some numbers off an earnings report. Think of this as a full-on structural stress test. We are going to examine the foundation. We're going to inspect the load-bearing walls, and we are absolutely going to search for any and all fault lines. The question we have to answer is really simple. Is this fortress still as impenetrable as everyone thinks, or are the cracks finally starting to show? Let's dive in.
Okay, so to do this right, we have to start with the bull case. Before we go looking for any weakness, we have to acknowledge the overwhelming, undeniable strength here. We're going to build this Fortress JPM argument piece by piece, brick by brick, using their full year 2025 results. This is the 30,000-foot view, and believe me, from up here, this company looks like an absolute monster of stability and power.
And the very first brick in that massive fortress wall, it's the top line. Just let this number sink in for a second. $185.6 billion in managed revenue for the whole year. That is a truly colossal figure. It's a testament to the sheer scale, the sheer reach of their operations all across the globe. We're not just talking about a company here. We're talking about an economic engine that literally dwarfs the GDP of entire countries. This is the kind of power you're buying into when you own a stock like this.
Now, looking at this table, what's really interesting is the full context. Managed revenue is up a solid 3% year over year. Okay, that's an extra $5 billion just flowing in the door. Now, I know the bears, they're going to immediately point to that slight dip in net income, right? Down 2%. But let's be realistic for a minute. When you are operating at this kind of scale, a $57 billion net income is still a monumental achievement. And look at the earnings per share. It's actually up. How? Well, they're creating more value for each share that's out there by buying them back. And a 20% return on tangible common equity, that's a critical measure of profitability, and it just shows an incredibly efficient use of their capital. So the bull case is crystal clear. This machine is running, and it is printing a ton of money.
And this slide right here perfectly illustrates the foundation of that whole machine. The balance sheet is the bedrock, and JPM's is pure granite. Look at this. $288 billion in CET1 capital. That's Common Equity Tier 1. We're talking the highest quality capital, the ultimate buffer against any financial shocks. And it's a number that regulators watch like a hawk. Total assets are $4.4 trillion. Average deposits, $2.6 trillion. This isn't just a bank. It's practically a financial utility that's trusted with a staggering amount of the world's money. And they're not just sitting on it. In the fourth quarter alone, they gave back $12 billion to shareholders through dividends and buybacks. That's a sign of immense confidence from management. The fortress is secure, and it is rewarding its owners, period.
All right, hold on. I hear you. The full year picture looks solid. I get it. A fortress built over 12 months. But we're traders, we're analysts, we live in the now. The market doesn't give a rip about last January. It cares about the trend today. So fine, I'll grant you the fortress looks good from a distance, but I want to get up close. Let's drill down into the most recent quarter, Q4, and see if the construction is still holding up. Is that top line still being forged with the same kind of strength? An excellent point. And you know what? Let's move right to that. The Q4 numbers actually reinforce the bull case. $46.8 billion in managed revenue just for the fourth quarter. That's a 7% increase year over year. See, this isn't a company that's slowing down. In fact, if you look closely, the most recent quarter actually shows an acceleration in revenue growth compared to that full-year average of 3%. So the top-line engine isn't just running, it was revving higher into the end of the year. So the really crucial point here is how they're pulling off this growth. It is not a one-trick pony. Just look at the balance here. Net interest income, that's the money they make from the basics of lending, it's up 7%. And then non-interest revenue, the fees they get from everything else, like asset management, investment banking, trading, also up 7%. This is what a perfectly balanced, diversified revenue engine looks like.
It's not overly reliant on interest rates going one way or the other, or on market conditions being perfect. It is firing on all cylinders, which is exactly what you want to see in a banking giant. It's a sign of fundamental health and just pure resilience. Whoa, hold on, stop right there. Firing on all cylinders, balanced engine? That is the story the headline revenue number wants to tell you. But revenue is only half the equation. It's the glamour metric, right? It tells you how much money is coming in the front door. What it doesn't tell you is how much is leaking out the back through rising costs and, more importantly, bad loans. It is time to stop admiring the architecture and start stress testing the materials. Because I promise you, when you apply pressure, that's when the cracks always appear. Look, revenue is strong, I'll give you that. I'm not going to argue with the number. But profit is what actually builds the walls of the fortress. And in Q4, I am telling you, I see a big problem. We have a saying here at Iron Financial: revenue is vanity, profit is sanity, but cash is reality. Anyone can grow revenue by just spending more money or by taking on a boatload of risk. But a truly strong company, a truly durable one, grows profit. So let's follow the money from that impressive top line all the way down to the bottom line, and let's see exactly where it went. And here it is, the first major issue. While that revenue number was up a healthy 7%, net income was down 7%. It fell by a full $1 billion, from $14 billion in Q4 of 24 down to $13 billion in Q4 of 25. So my question is pretty simple. If they brought in more money than ever before, where in the world did the profit go? This disconnect, this gap between revenue growth and profit growth, is a massive red flag. It tells you something is getting way more expensive, something is getting riskier, or something is starting to break down deep inside that machine. And here is your answer. This right here is the first real crack we found in the foundation. Just look at the explosion in credit costs. They almost doubled in a single year, jumping from $2.6 billion to $4.7 billion. That's a $2.1 billion increase. So that $1 billion drop in that income we just saw, well, it's more than explained by this one line item alone. This tells us the bank is actively preparing for more of its loans to go bad. This isn't some minor leak. This is a really significant increase in the perceived risk of their entire loan book. But you can't just stop there. A good analyst never just sees the number. They have to ask why. Why is the number what it is? Why on earth did credit costs just about double in 1 year? It wasn't because the entire economy just soured overnight. No, the report gives us a very specific and very large reason. It's a name every single person knows, and it's a product that represents a massive new bet for JP Morgan. So what is the deal with the Apple Card? And here is the smoking gun, $2.2 billion. That was the amount JP Morgan set aside as a credit reserve specifically for the forward purchase of the Apple Card portfolio. This one single transaction, this one deal, accounts for the entire net reserve build for the whole quarter. They've essentially just taken on this massive new book of consumer credit, and they had to immediately, day one, provision over $2 billion against potential losses. This isn't just a business expense. It's a multi-billion-dollar bet on a new, and you have to assume, a potentially riskier pool of customers. It signals a major strategic shift, a recognition that to grow in consumer finance now, you have to partner with big tech. But that partnership, well, it comes with a hefty price tag and a whole lot of uncertainty. This is a significant fault line. You're absolutely right to flag the Apple Card reserve. It's a huge number, and it absolutely cratered the Q4 profit. It's a big, forward-looking bet. But framing it as only a weakness, I think, is a mistake. A fortress isn't just one big wall, right? It's a series of interconnected structures. If one area is under construction or being reinforced, you have to look at the health of the other engines. So let's go inside the engine room and let's check the performance of the core business segments. I think you'll find that the powerhouse divisions are doing more than enough heavy lifting to compensate for this one-time provision. Okay, let's start with the real heavy lifting engine, the commercial and investment bank. This is the Wall Street powerhouse. And just look at these numbers. Net income, up a strong 10% year over year to $7.3 billion. Revenue, also up 10% to $19.4 billion. And then inside of that, look at markets revenue, that's their trading division, up a staggering 17%. So while the consumer side was taking on that big provision, the CIB was absolutely crushing it, generating more than enough profit to keep the entire enterprise charging forward. This is the core strength of JPM's diversified model. When one part of the business faces a headwind, another part thrives. Crushing it? The CIB had a good quarter, I'll give you that. But while you're focused on the Wall Street engine, the Main Street engine is sputtering and badly. Let's look at consumer and community banking. This is the division that actually touches the lives of average people. Net income here didn't just dip, it collapsed by 19%.
revenue growth was way weaker than the investment bank. And look at the credit costs, $4.2 billion, an increase of $1.6 billion year over year. This isn't just about the Apple Card anymore. This signals real, tangible stress for the American consumer. And when you see numbers like this from the nation's biggest bank, it's a potential warning sign for the entire economy. You can't just brush this off.
You're focusing on the consumer weakness, I get it, but you're ignoring the hidden gem, the real high-margin profit driver, asset and wealth management. This is the quiet engine that just consistently, quarter after quarter, delivers. Net income up a mere opposite 19%, revenue up 13%. Assets under management ballooned by 18% to $4.8 trillion. But the most incredible number on this slide by far is the ROE, the return on equity, 44%. That is an unbelievably profitable and efficient business. It's a pillar of stability and high-quality earnings that acts as a powerful counterbalance to all the volatility in the consumer credit space. This is precisely why the fortress stands. It's built from multiple incredibly strong materials.
Okay. So we've got a tug of war. A strong investment bank and wealth manager on one side versus a weakening consumer division that's taking on a big new risk. The past is a mixed bag, I'll admit it. But investing isn't about where a company has been, it's about where it's going. So let's stop looking in the rearview mirror for a second and start looking at the blueprint for 2026. Does management's own guidance suggest these positive trends are going to continue? Or are they quietly warning us about future costs and rising risks?
And this right here is where the blueprint gets very, very concerning. Look at the expense line. This isn't just a crack, this is a foundational cost issue. In 2024, they spent $91 billion. In 2025, it rose to $95 billion. Okay, fine. But look at the outlook for 2026, a massive jump to around $105 billion. That is a nearly $10 billion increase in projected expenses in a single year. You simply cannot grow profits if your cost base is accelerating that aggressively. It raises really serious questions about future margin pressure and profitability. Where is all that money going?
But you're only looking at the cost side of the ledger. Let's just pause and look at the full picture here. Yes, expenses are guided higher, but net interest income, NII, is also guided to be incredibly strong, around $103 billion firm-wide. That's a huge number that is going to help offset those costs. They are clearly anticipating continued strength in their core lending operations. That's the engine that's supposed to pay for all that new investment. But that NII number comes with a huge warning label attached. Let's take our time with this because it's critical. On one side of the scale, you have that $103 billion in NII. On the other side, you have the $105 billion in expenses you just saw. I mean, the margin there is already razor thin. And then you have to look at the other piece of negative guidance. They're explicitly telling us to expect the card services net charge-off rate, that's the percentage of loans they know they won't get repaid, to rise to 3.4%. So what you have is a toxic combination: rising expenses and rising consumer defaults. That strong NII guidance could get eaten alive by higher costs and higher losses. It's a very, very precarious balancing act for 2026.
So there you have it. That's the evidence. The bull case is a massive, revenue-generating fortress with powerful engines in CIB and AWM. And the bear case is one of declining Q4 profits, soaring credit costs driven by a risky new venture, a sputtering consumer division, and a blueprint for rapidly rising expenses. It's time to step back, weigh the foundation against the fault lines, and deliver the iron financial verdict.
All right, let's summarize this. The foundation is undeniable. We have massive revenue growth, both for the full year and actually accelerating into the fourth quarter. It's built on a fortress balance sheet with just immense capital reserves, and you have absolutely stellar, world-class performance from the investment bank and the wealth management divisions. That 2026 net interest income outlook remains a powerful pillar of support. But the fault lines are just as clear, and they can't be ignored anymore. We have a clear decline in Q4 net income despite having higher revenue. The culprit is those soaring credit costs, almost entirely due to that massive $2.2 billion bets on the Apple Card. The consumer division is clearly showing weakness, which signals broader economic stress. And the company's own outlook points directly to a dangerous combination of rising expenses and higher credit card defaults. These are not minor issues. They are significant structural risks.
So here's our final verdict. The fortress stands, but our stress test absolutely reveals clear fault lines. This is not a crumbling ruin. Let's be clear. JP Chase remains a dominant financial powerhouse, but it is no longer a simple set it and forget it kind of buy. The complexity and the risks have clearly gone up. This is now a structure that demands vigilant inspection from any investor.
The combination of that rising consumer stress and a massive new credit card portfolio, all layered on top of an accelerating expense base, it just creates significant uncertainty. For the prepared investor who really understands these risks, yeah, there may be an opportunity here. But for the unwary, this fortress could easily become a trap. Stay sharp and stay forged.
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.